that you do send to us. Let's get straight into it, Julia. What did you make of it? It wasn't the best of ways to start the week.
James, it was such a quiet session. We only saw about $3.2 billion worth of stock being traded, so it felt like the Australian market was half asleep today, down by 0.4%, and really not surprising given that we did see the negative lead come through from the US on Friday on the back of disappointing GDP numbers. We also saw China coming back online after its Lunar New Year holiday, and it was down by 0.4%. The market a little bit disappointed that we didn't see monetary easing coming out of China, a cut to the reserve ratio requirement or interest rates in China, and that really weighed on the market. And of course, all eyes on Europe tonight, where we do see the EU summit as well as the Italian 5 and the 10-year bond auctions. If we have a look at our market, there was a lot of activity in the staple sector. We saw Woolworths down by 1.3%, and that's ahead of Woolworths' second quarter trading update. So it does look like there was some selling ahead of that update, which is due tomorrow. We also saw the big four banks losing ground. That's not surprising given they saw such a stellar week last week, where they were the best performing sector with a gain of 2.1%. But on the flip side, we saw the uranium miners outperform for once. It has been a difficult 52 weeks for the uranium miners, but they have started to gain some favour in 2012, with most brokerage houses quite positive on uranium. So Paladin was an outperformer, up by 5.8%, and we also saw ERA up by 4.4%, but altogether a pretty quiet Monday. 3.2 billion traded, really the market not doing too much.
The movements amongst the retailers, a rather bold call on lunch money today by Chris McDonald from RBS Morgan's, a very bold call suggesting, hey, maybe we've seen the bottom of the cycle, if you like, in terms of some of those top line retailers. A bit too early to call that or not?
If we have a look at retailers, they're down by 40 to 60%, the discretionary retailers, over the last 52 weeks. So they have been absolutely battered, and so there's a lot of bad news which have been priced into the retailers. But one of the themes that we have seen emerge over the last couple of months and will continue in 2012 will be the falling interest rates that we see in Australia. And in terms of sectors, there's going to be two areas that it mainly benefits. One are the retailers. The fall in interest rates should see some more discretionary spending, and the other area is the property sector, which becomes more attractive as interest rates fall. So these two sectors should really benefit as interest rates continue to fall in 2012. So I guess the big question is, there's already a lot of bad news factored into the retailers. Can it get any worse? And I guess the market view at the moment is, with interest rate cuts being priced into the market, that perhaps there could be some positive upside from these very low levels that the retailers and the property sector has fallen to.
Bit of a compensation deal almost because of the carbon tax. Shares didn't really respond all that favourably, though, closing down almost 2%.
James, initially the share price reaction was positive, but by the end of the session, the market realising that this area still has quite a few challenges. The carbon tax will be implemented later on in the year, and this money was supposed to use to offset some of the, I guess, some of the results of the carbon tax on this industry. So that payment has been brought forward, $64 million, and it will help given that one still has been under pressure because of the demand for steel products being a little bit softer because of the construction area being softer, especially coming out of China, the high Australian dollar competition from foreign countries as well. So I guess in terms of today's announcement, good news for One Steel. One Steel's a little bit different from BlueScope in that it does have its iron ore operations, and in the December quarter it was a little bit difficult because we did see softness in the iron ore prices. Now brokers are predicting that iron ore prices will recover in 2012, and that should be a positive for a stock like One Steel. But if we do continue to see iron ore prices soften off, then the possibility of a capital raising by One Steel, of course, increases. The forward payment of this decreases that probability. Initially, we saw a positive reaction, but by the end of the session, the stock was actually down by 0.4%.
Might it too late to start getting in on these stocks? Because there's been a big rush there. We've seen a big increase in a lot of prices.
It's all about the price, and in the last quarter, Monadelphous is up by 20%. So not surprising that we did see a negative reaction in terms of the share price. Not a big one. It's down by 0.4%. Still a favour of brokers, but given that the stock price is near or above the target price of most brokers, we're not seeing a lot of positive momentum into this stock. But if we have a look at the underlying business, Monadelphous is a preferred supplier of some of the large miners out there, including BHP Billiton, Rio Tinto and Woodside. And if we have a look at its this business, its maintenance revenue provides stability to its revenue, but really the swing factor comes from its engineering construction part of its business. And if we have a look at this area, then we have seen a delay to a number of big projects, and that's because of the shortage of front-end construction engineers as well as design people. And if Monadelphous manages to keep its key people in this area, then it should continue to gain some pretty lucrative contracts. So we've already seen $1.5 billion worth of work in hand for FY12, and that's a huge positive. But of course, the share price, it's trading at a premium to some of the other engineering services companies. So I guess in terms of cheaper companies, NWH, Cardno, these are trading at discounts to Monadelphous. And Monadelphous is trading at a premium because of the quality and the construction of its earnings. It is a preferred supplier, but it really needs to keep on winning these lucrative contracts for its share price to be able to grow any further.